Today we're going to be talking about trading the fast moves. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. We have had some huge moves this week in almost every single pair, at least one day of the week. Gold, of course, has been moving every day. And a lot of questions. We'll try and answer them today. We're going to review a couple of things, but we're going to be talking about trading the fast moves. Last night on gold, it was a fantastic example of the market selling from the high at the open, very fast down and very fast back up. We'll talk about the dynamics of that price action, the speed of that price action, some of the manipulation tactics, and again, reiterating a lot of questions about the gap times. I'm going to talk about my perspective on the gap times and also routines and habits about trying to duplicate, reproduce, and not engage in self-sabotaging trades or behavior. So, trading the fast moves. Again, something I learned from Bill McLaren. 3 push patterns, creeping trends, breakout pullbacks, and hesitations before the fast move continues. The fast moves often will build up over 3 pushes. Again, we talk about the stop hunt. It's a conceptual understanding of not trying to trade the swings and the trends. The gap times, in my perspective, unless you are at the high or the low of the day in that pre-market time frame, so again, within that 1 to 2 hour window of the 12 candle window, we get a stop hunt, which is usually the continuation from an existing trade. So we may have a trade in London or in Asia that blows off in 3 pushes, culminating in the gap time, putting a peak formation in either before the US session or before London. So again, tradable, but more so if we come to the screen at a set time and that is already in place, we want to be trading in the direction of the new trade that's in existence off the high or the low. So for example, they blow it off in the gap time in 3 pushes, they lock it in with an engulfment, a pin hammer. As we come into our London window, well then obviously we want to be trading in the direction of that trend, because we could be waiting now for 3 hours because that trade now may culminate in 3 pushes up to the high or down to the low, depending on which way it came from, over the next 3 hours before it builds up to come back and stop hunt the traders who are in the existing long trade. Now again, just to reinforce, we're not talking about counter trending trend trades. We're talking about nobody gets a free lunch, and on a typical trading day, the market will usually come back to get traders who are in profit. Now, if we have a Monday, Tuesday setup on the low of the week or the high of the week, we may be in a trend day for the rest of that session, right from the start, right for the entire session. That's not what I'm talking about, but rest assured, in most cases, they will come back by the end of the week, if not the next week, to get that trading, that trending day, whether it's a reversal week coming back the other direction, or if it's trading the next day back into the trend before resuming the trend, whether it's a downtrend or an uptrend. But it's more of an understanding that when the market builds into a market open, over 3 hours it's had creeping trends, or it's had a stop hunt to the high or to the low with pins on either side, the market is probably going to come back in the other direction very fast and quickly. So a couple of questions regarding trade setups. Again, median price, just using any numbers as examples, but these pairs generally respect 50 pip boxes, gold 100 pip boxes, but most importantly, 50 and double zeros are important. Now, it's important to understand if you have a high of the day up here coming into a session. Now again, just to reiterate, as we head into each session, the previous session's highs and lows, if we're inside or if we're working one side, are the most important levels. Those are existing high of day, low of day scenarios. For example, if Asia trades and sets a high and a low, that's the high and the low for the day in that Asian session. Now, unless we break out of that to make a new low and we're working for a new low or a new high, that is the high and the low. Now we may be inside of a previous day's high and low. So it's important to understand if you're in a trade and you're buying low for a move back to the high, it may stop at the previous session's high. If it's 50 pips and all of a sudden it hits that and stays under, breaks out, pulls back and stays inside, as we saw last night on gold, it did a 25 pip extension on the previous session's low of the day, and it came back, it consolidated on the 1 minute chart over 15 minutes, 3 pushes, and came right back 50 pips on the next candle to get traders who were short off the high that were up 75 pips. So it's important to understand that the high and the low of the session may be the critical levels. And again, coming back to round numbers, but it may blow right through that high of the session, layer on top or pull back on top or push into it if it's a down move, and continue to the previous level above or below. So median price, if we have a low and the market's trading around zero, okay, chances are, remember, there's stops above this level. Now, we may be trading around here, but they might be trapping volume underneath of the double zeros, and we have stops above here, especially as we head into a next session. Now, the same goes for the other way. But if the market has broken out and pulled back and working down inside the quarter, chances are it's going to go back, and when we go above double zeros, we're going to 50. So it may fail at a quarter level if there's previous price action there, but in most cases when these markets are creeping trends into round numbers, they're going to explode for at least a 50 pip move. Now that comes back to obviously understanding, are we in a peak formation that's coming back down to hit stops down here, or are we in a breakout pullback creeper down into the numbers for a move up? So we've seen some very strong, fast moves this week. Creeping trends, I keep talking about this, creeping trends are building up pressure, they're coiled volume. They will either blow off in the direction of the trend or jam in. So if we're in London and we sell high and we get, it's not going to the 50 pip mark, we get one push, two push. If that second push fails, pay attention to that price action. If you get a little bull candle, we saw this on the pound yesterday, one push, two push, and then two little bull candles and an explosive move back up. So if that market is not following through on that second push, start paying very close attention, because now you're looking at coiled volume that will explode potentially back in the direction of where you shorted or went long in that trade. But the longer a market coils and pushes into a box and it's not going anywhere, and we're getting into that next, whether it's the gap time. So again, if we get a gap time trade, we're going to be moving, we're going to be trading in that direction when the next 12 candle window opens. So we get three pushes down, it breaks out, we might get a 1, 2, 3 at the beginning of that first hour in the US session for an explosive continuation in that next equities hour. Question, people say, what are you referring to as the equities hour? I refer to that middle hour as the equities hour. Typically that's London, New York, Asia. You can argue which time is which, but to me that middle hour is where, if the first hour puts the high in place or the low in place, the second hour, especially if it moves 50 pips or more, or at least 50 pips, if it's only 25, it might move 25 up, come down and put 25 in that first hour. Now we have a high and a low. But if we're working in one direction in three pushes, that first hour is typically putting the extreme in, and that second hour will often lock it in or shift and move in that next hour to either put a new low of the day in place or to lock in the high before it shifts away for a measured move. So timings. I'm getting a lot of questions about what time it is in Central Africa and Sweden and Norway. Just Google. I don't even know what my server candles are, different times. That doesn't matter to me. I strictly go by New York time. Luckily in Perth, except for right now when New York goes on daylight savings time, but it's normally the exact same time here in Perth as it is in New York. Now we're an hour ahead, so I just subtract an hour, everything's an hour later. But I base everything on New York time. It's entirely up to you whether you do that or not, but I have one big piece of advice regarding that. My main concern being in those gap times, unless I am at the high or the low, specifically at certain timings. When you are inside of those gap times, if you are inside of the highs and lows, there is a very strong possibility that you could get caught into some false moves and get jammed in, especially if you're putting, size on or trading something that looks really, really tasty. It looks like a great move. It's going to blow off. You short it or you go long. You put a little bit extra size on because you've been doing well and the market's been moving. You've been doing great. All of a sudden it stops and it starts to counter trend a little bit to your trade entry. Next thing you know, it's pulling a bit further away, and now you potentially could be caught in the middle or 25 to 50 pips away from where that market is going to finally go to do a stop hunt to the high or to the low before the next session opens or when that next session opens. So I've learned some very hard lessons from trading in those gap times. The zombie hours, I've had lots of people call them different names. I am really looking specifically at that first hour. I have made a lot of mistakes in those gap times. I would encourage you to again identify it. Yesterday and on Wednesday, gold has been absolutely textbook perfect in terms of literally just at each session going to the high or to the low and then trading off of that. Very specifically, right to the high and then bang, it reverses. Right to the low, bang, it reverses. It went 25 pips past the low last night, but that was on the stop hunt and it reversed immediately. But into the open, it hit the high from that hour, it breakout pullback, and then bang, it just dropped 75 pips. So these markets will move quickly. And again, I've learned some hard lessons sitting at the screen, being in these garbage trades that have cost me money, that looked really good at the time, whether I was overconfident, over-elated, whatever. But when you go to the screen and there's a stop hunt and a trade entry right off the bat, and bang, it goes 75 or 100 pips to the low or to the high of the day, and you're done in 1 hour, that is when you realize that's how trading's supposed to be done. This other garbage where you're caught into stuff and you lose some, you win some, you average into a loser, you do all kinds of stupid mistakes, when if you just sell at the high or buy at the low, that's it. You got a 1 bar stop. It's either right or it's wrong. And if you're wrong, well, you can get back in on the next trade. So you lose 1 R. Those trades are typically at least 2-3 R. So it's really important to hammer home on some simple trade setups. It's hard sometimes, but this is why most retail traders will fail, because they'll repeat the bad habits intermittently. When you blow up, you do everything really meticulously right. You go back, you do everything right, you use very small lot sizes, you just focus on the perfect trade. You don't care if you get a trade or not because you just want the perfect one. But as you get better and better and better, you start meandering away from that path again, taking some of the poor quality trades, trying to scalp some pips, putting more size onto a scalp trade or a little trade that's not really part of your best trade setups. And that's the ones that usually will end up causing a lot of damage or causing you to engage in self-sabotaging, emotional, impulsive, and irrational behavior. High of the day, low of the day. Again, that can be the high of the session, low of the session. How do we know? Because you've got a peak formation, high and low. But when we go into that 12 candle window, we want to be watching how that market respects the high or the low that you've drawn. If it blows through that or it's moving through that, well, we're not at the high or the low yet. They're putting a new one in. It may be a 50 pip stop hunt back against a trend. But that doesn't mean it's not going to put a high of the day in place before it drops down and does a measured move or comes down to the low of the day. Timings 8 to 11 p.m., 2 to 5 a.m., 8 to 11 a.m. That's my 3-hour window. Very specifically like to see something in that first 2 hours. But as we see, that 3rd hour yesterday on the pound, there's a lot of great trades that build up over that 3 push pattern. For me specifically, I'll look more for those in the London 12 candle window than I will in the US. There are a lot of good trades in the US 12 candle window towards the end of that 3-hour window, and also towards the close of the day. Now, I don't trade those because I'm asleep. Round numbers, double zeros and 50s. But again, studying median price and understanding you're either inside of 50 and 0 or you're around a major round number. If you're around a major round number and there's highs and lows above there, watch how price has built up that box, because the numbers above those double zeros, if they go back to that level, they're going at least 50 pips inside of that box above double zeros. Gold will probably go 100. Now, another question that came up. So, important to understand a couple of things. If we have a high of the day and a low of the day, the market goes in that first 3 hours, pushes up, or first hour, sorry. We get a trade in that second hour. It's coming down. We have a low of the day over here, high of the day. This happened on, I believe it was pound Aussie. We were up high for the week. Monday, Tuesday, Wednesday's up here. Third hour, we get a pin bar inside. Carr sent me this screenshot. The low of the day was here. The pin bar was on top of the low of the day in the third hour. Okay, we have a short trade from up here. Okay, we're up high for the week. So Monday, Tuesday, Wednesday, we're up here. This is not a trade. That is not a stop hunt. This is a trade. What we need to see, this is the low. This is potentially now the low though. That is the low of the day. But because we get a pin bar inside of this move, that's a trap. Doesn't mean that that's not the low, but what happens is that they come back on the next candle and they go down one more time before they pull back and reverse. It is the low of the day. Whenever you get filled off the numbers inside of a box or inside of the low of the day, that is not a stop hunt. That is a stop hunt. Then you watch to see how price behaves right there. We want to, if you're in a downward leg and you need this and you want a buy signal, we want to see a W or a second leg, an extended W, a shortened W, whatever that may be. But usually that will culminate on 3 pushes. The first one puts a low of the day in place. The second 2 retest that before that springs. That's a coil. That's 3 pushes. Boom, explosion. That is not the same as being down low Monday, Tuesday, Wednesday and getting a 1, 2, 3 and a 2-bar reversal at the low of the week. That is not the same as selling or buying the low inside of the box. I hope that makes sense. When you're down low and it goes 1, 2, 3 and you get a 2-bar reversal, that's the low of the week. But when you're up high and they're coming down from an existing short trade, we need to see 3 pushes or a W, a 2-push pattern, whatever that may be. But the first pin, especially when the low of that pin is inside of the box, the quarter level as well, you're getting filled inside, that's a trap. Remember, a stop hunt will be through a level. It goes through and pulls back. Then we watch to see that second candle confirm that, and usually I'll look for, we could get an engulfment, and I'll look for a small little bull pin beside that engulfment. That little candle shows up everywhere, and usually it's not even 10 pips. Once you see that little bull candle or bear candle after they've locked in a level, that market will take off from there, and that little candle is as big a stop as I'll use on some of the trades. So hopefully that makes sense. Round numbers, median price, that allows us again to focus on understanding if this is median price. When the market opens, most of the time you'll be at median price. When that market opens, you'll be at median price. And what I mean by that is you don't want to be in the middle. You want them to take it out. You want to be selling up here or buying down here. So doesn't mean I'm blindly getting in when it gets 25 pips away from a level. We say most stop hunts are 25 to 50 pips. So we get to this first quarter level, we might be in a breakout. How do we know? Because we know how price behaves when it gets there, and also the timings. If it goes up there in the first 15 minutes, I want to see it pull back and start working it in the second 15 minutes if I'm looking for a sell signal. But if it continues through and keeps going in that second 15 minutes, I know they're not done. That first 45 minutes to an hour establishes, in most cases, the high and the low of our next session. So that equities hour will either confirm that and reverse or continue to extend it out. So, people have said, I've used the term anchor point before, and people say, what is anchor point? I've never heard that. Well, here, if the market starts from here, that's my anchor point. That anchor point is where I'm looking for at least that market to come back to, and possibly, depending on the timings of when it gets there and how many boxes we're in, possibly a measured move into the next session. So the anchor point is usually going to be the extreme lower high when that session starts. Now, we may already be at the high, so maybe that anchor point is a trap, and they're going to trap that volume and shift away. But again, there's our geometry, there's our structure. So that anchor point gives us the start, and again, these 25 to 50 pips, and I'm going to say this, if it goes 75, that's 3 levels of rise and fall. Chances are that's going to be the range for the day, high and low, unless it's gold. Gold will easily do a measured move of that, and in most cases will work in 100 pip increment boxes. We'll look at some examples of those charts, but remember, the fast moves will come out of a coiled market, 3 pushes, working the low, working the high, or putting a peak formation in and then coming back into the open of the 12 candle window or in that 12 candle window and stop hunting the extreme, especially if the market's been working up or working down. That stop hunt occurs at the extreme. They lock in that level after they've hit all the stops. So, golden rule, if you're inside, we saw this on Tuesday on gold. The market will go, we'll look at that chart. The market was inside. Okay, it put a high in Asia, put a high in London, came back inside, it was in here, bang, went to the high, and came right back inside 50 pips, consolidated, and rolled over. The trade was up here. Spent about 5 minutes up there after the candle closed, and then it reversed right away. So, point being, if you're not sure if the chart is messy or anything else, put some alerts on your computer. That's why we look at 2 or 3 pairs looking for simple stuff. And also, if the market doesn't give you a good trade setup, also be comfortable with not taking any trades. Trying to look for trades or again, that first hour, I'm looking for ripe fruit. I want to pick the easy, low-hanging fruit that's fresh, that's ready to go, and I want to be done hopefully in that 2-hour window, and no stress. No stress trades are like this. You get in up here, you have a stop in place, and bang, it drops in the next 2 candles and you're up 50 pips. We saw that last night on gold. It just fell 75, 100 pips, and then it reversed and did 50 pips in 15 minutes. So keep it simple, traders. Stay on the outside. They're going to hit the stops, guaranteed. If they don't hit the stops, really important to understand this, if they just barely pip a level and reverse, don't worry, there's going to be a trade on the other side. Now, we'll get more into detail on some of those trade setups, on how to identify some of those ones that are going to reverse quickly, but we'll look at some screenshots from yesterday and Wednesday's trades. Have a great trading session. Hopefully end the week on a strong note. Have a great weekend as well, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Just reviewing trading the fast moves and just again reinforcing some simple concepts. For me, I like to stay on the outside. I'm looking for stuff right off the bat in terms of a stop hunt and then a trade reversal, breakout, pullback, continuation, whatever that may be. But looking at gold on Tuesday, we had obviously the previous day's high and low, and the question I had for myself was, well, we have a peak formation in place up top. We have a peak formation in possibly for the week down low. But the way that the market set up early in Asia, we had a swing low inside and a swing high. But again, the market came right up to the high, and again, not in our first hour, but a 3rd hour trade. They put a low of the day in place, and then proceeded to work up towards the high of the day. So coming back to some simple concepts, again, just talking about where the money is. When you're up here and you get a pin to the high, an inside bar or a small bar, and then a pin hammer to the high, you've got consolidation at the high of the day. You've got a high bull, and again, it's risk reward. We talked about one bar stop. Traders are long in here in Asia. They're long somewhere maybe on the shorter time frames, maybe the 15-minute, doesn't matter. But they either have stops at the low of the higher lows of the session or the overall low of the day. And so we get up top. Again, we got a box. We've gone up around the median price is double zeros. So we've gone 25 above. The low of the day basically is 25 below. Excuse me. But also you notice the wick is down below as well as the swing low. So if the market comes down this far to hit stops, there's a possibility it may extend down even further. So we've got now a 75 pip box. So targeting 50 pips on this trade is a very realistic target because we have a 50 pip box, but we also have slightly more than 50 pips in terms of extremes. And that's important to sort of do the math and understand that, well, okay, I'm up high in a 50 pip box. I got at least 50 pips from low to high. But the market comes down, one push, two push, three pushes, engulfs. Now we're in the gap time. So I talked about this. The market comes down three pushes and engulfs and pulls back to the 50% level, which is around numbers. We get a bear pin hammer and the market comes down and stop hunts to the low of the day. So question again, the market performs a stop hunt. Now we're looking for a trade. Well, they make you chase this trade. Break of the high, the second candle of the London equities hour, they break to the high. First, if traders were to take the break or they didn't do anything at all, they missed, but they also have a 1, 2, 3. So traders have messaged me and said, well, how would I have gotten in that? How would I have gotten in that? Well, you may not get this trade, but they've come back to the high of the day. They pinned up through that lower portion. They went through the middle structure. Okay, so some traders were looking for the measured move. But again, it's all about how price behaves when it gets to the high and the low. They come up 1, 2, 3. Our third hour, they've hit the stops. They've hit the highs. Inside bar, that's consolidation now. And an engulfment on the last candle of the the third candle of the third hour. So a 1, 2, 3, and then sideways engulfment. Now, again, we talked about this the other day. You short this market, it comes down 25, not quite 50, pulls back, comes down a second time, no follow through, pulls back, comes down a third time. Now we're heading into the gap time, the beginning of the 12 candle window for the U.S. session. So this is where we see a coiled market, 1 push, 2 push, 3 pushes, and bang, they come right to the high. This is brilliant. This is textbook perfect. Pin to the high, 1, 2, 3, engulfment, round numbers. We talked about this the other day. So just simple, 1, 2, 3, explosive move to the high, engulfment, fight for a better fill price, round numbers, whatever it may be. They've thesis again, they've locked in the high of the day, they've hit the stops. Well, where are they going? Where are the next set of stops? Well, they're going to be down from the traders that went long in London, possibly. So we got our low of the day in place. They come down, they drop it and go sideways, but there's 50 pips there. They come sideways, and that is a measured move, by the way. So if we take our tool, again, traders have asked, what is that fib tool or measuring tool? That's just my Fibonacci tool that I've just changed the numbers in. I've put 50% and 100% expansions. Again, that's just something I learned from Peter Brandt. I like to measure rectangles and look for expansions of those ranges. So fast moves, stop hunt. Fast moves come out of these coiled markets. This is tradable. But again, if you're inside, now we're inside, this trade can fail at the high. You notice how that pin pulls back? So again, if you're in this trade, think about the psychology behind that. You're in this trade, it pulls back, you're holding on to it now, hoping it continues back up. You might have got in somewhere around here. Who's underwater now? Look how fast they've come down. That's the rationale you got to understand. Some traders went long there, and their stock, if they were on a shorter time frame or even on the 15-minute, they've gone to break even, or they're holding on to it. They're in negative equity at that moment. So It's understanding that the high, when you see this, not only have they locked in the high and you can short that, but they got people trapped in here now who went long. So that's the stuff you want to be thinking is who's trapped. I've talked to Carr earlier this week about where the money is. The money's always up top and down below, but you can see who's trapped inside. These people are not in the money. They are trapped. And if they have stops outside of that, their stops are big, which means their losses are going to be big, which is why they're going to hit them, because then they put more money in their bank account. We go to the next day. We have our low of the day. They come down straight off the bat. They go up 3 pushes right in the rollover time and then bang, hit the stops. Pull it back. Creeping trend down. 3 pushes. Bullpen hammer at the end of the 3-hour window with an engulfment. First place they do is go back to traders who are short in the equities, in the Asian session. They hit the stops, and then what do? They come right back and hit the stops on traders that are long that have gone to break even, and they immediately come back, engulfment, little inside bar engulfment, not only to get traders who are short, but also traders who are short at the beginning of the session. This was a brilliant trade setup. Again, that first hour, 1, 2, 3, but no stop hunt yet. Pull back, first candle of London, and then bang, they hit the stops, go into consolidation, engulfment, bear pin hammer for the 50 pip move to the low of the day, but also a measured move. So again, this is a perfect geometrical structure. And again, we don't know if it's going to be a measured move. So some traders have said, you don't know where the market's going. How can you say that? No, well, I don't know where the market's going. It's all about how price behaves when it gets there. So you've got 50 pips and you might be out of the market. It breaks through and pulls back. And this is what I was referring to as an anchor point. When they pull back and you see this market 1, 2, and then bang, they hit it again. And then in the gap time, 1, 2, 3 down, and that doesn't follow through. We get an explosive bullpen hammer off the round numbers at the beginning of the 12 candle window. So we've got this guy up here in the money. And now we've got a market that didn't follow through if you shorted it here. So if they come up here and then you've got a inside bullpen hammer at the beginning of the equities hour, understand that traders who shorted the market here now, if they haven't taken money off the table because they think this is going to go down forever, now they're in trouble. They're not only stopped out at break even, but if they hold on to this, they're going to be having a bigger loss. So it's always about who's caught and where the stops are. So this guy's up here in the money. Let's go get the money. This guy was in the money. Now he's not sure what's going on. So they're going to go through him, pull back, but they're not going to come back down here, because if they do, that means this guy can get out without a loss, and they're not going to do that. And if they come back down here, even people who shorted this down here, hoping that was a follow through, they're really in a big loss. So again, they come up and hit the stops, pull it back, go into consolidation. The consolidation is your clue. Once they pull it back and go into consolidation, you know they're going back in the other direction for either 50 or more pips. Now this market, gold, obviously moves quite a bit. It's one of the reasons I am really like trading it, but it is tricky. But again, just stick to the timing windows and the highs and the lows. We saw a fantastic setup last night. These higher lows inside of the gap times or lower highs are clues, because when they don't go down all the way and they come back and they get traders chasing the move midway, that means, again, when this market jams in and you get a fast moving bear pin or anything else, you'll notice the close catches these traders in negative equity. So whenever you get these higher lows, lower highs, those are ripe areas to be paying attention to if the market does start to consolidate and compress. Especially, again, we see the bullpen stop hunt on the second leg, engulfment. Bear pin hammers, a little retest on traders that are short. They're off the blue tracer from the previous day's low, so they've broken out, pulled back, jammed it in, pulled it back, jammed it in again, come back. Consolidation, we may potentially be in a day zero scenario, a narrow range day. We've layered on top. So they went consolidation, now they've broken out and pulled back. This may potentially be an area where we may see, we'll just zoom in this, it's possible we could see this market head back up towards that area. We have maybe a reversal type situation setting up where the market has put in a peak formation low, worked it, broken out and stayed on top. Now again, if this market was to pull back inside, we could see it retest the lows, but we could see this consolidation continue, breakout pullback continuation for a retest of the anchor point highs up top. So looking at the pound from yesterday, this is a great example. Again, there was an opportunity to sell at the beginning of the 12 candle window. We see a stop hunt to the high. Some traders sent screenshots and they hit this trade. Great trade, but an example of where we see the stop hunt, the reversal bear pin hammer, and then the engulfment bear pin hammer. Possibly looking for a range expansion, but again, we're on a Thursday, day 4. If we scrunch our chart up, we can see that we're inside. So Monday, Tuesday, Wednesday, we're inside. The thesis maybe was that this market could continue down to the low of the week. But I was talking about also understanding that one push down, it pulls back quite strongly in that 25 pip box. Retests the low again, pulls back, and a third push down. That's 3 pushes, and the market has failed to break those lows. That's a coil. 1 push, 2 push, 3 pushes. These little bull candles at the bottom, at the end of the 12 candle window, are pure gold. This is a coiled market. When you see this little bull pin down low after 3 pushes, there's your 1 bar stop. That is going to explode, and you have your 35 to 50 pips. If you got in at the break of that candle high, you're looking at 32.15, 32.14. That market gave you your 50 pips on the second push through. But a great example also, the gap time. Okay, so there's a trade that happened just outside of the 12 candle window. They stop hunt hard and fast to the high of the day. Basically, they get traders who even shorted it on the rollover, but they pin the high with the inside bar and they pull back. There's your gap time short at the high of the day. Now we want to be trading in the direction of that short back down to the low. When that 12 candle window opens, if that's when we come to the screen, we are purely trading in the direction of the trend, whether that's the break of a bull candle, whether that's just getting in and having a 1 bar stop once a bear candle prints, whatever that may be. A 20 pip stop, it doesn't matter, but we're targeting the low of the day. This market didn't quite give 50 if you got in the 12 candle window, but again, just being aware that if you were in a market like this, when it hit the low and pinned through on that second candle, you'd be wanting to tightening your stop up or covering that trade because there's no follow through. Whenever a market pins a level and does not penetrate it, I will cover that trade. Again, we talked about Wednesday. Another example, again, just breakout, pullback, continuation as we head into the next 12 candle window. So we had higher lows as that session progressed, but the breakout pullback happened in the gap time. Again, we want to be trading in the direction of the 12 candle window. This is not a stop hunt. That's a breakout. Also, if you miss this, if you're not in this move right off the start, so obviously if you're trading this, you just trade the break of this candle as the window opens. But if you're not in this trade and you're looking for the reversal, again, 3 pushes, 1 push, 2 pushes, and then a 1, 2, 3 in that third hour, an engulfment. So now we have a high of the day. The market consolidates before engulfing a second time. So they've worked the high, engulfment. But then we also have 3 pushes down, 1 push, 2 pushes, and then a third weak push at the equities hour before we get the engulfment. And again, just thinking, where is the money? The money's up there. We're breakout pullback in 3 pushes, engulfment off that high of the day from the previous day. That market closed at 79 with your fill. It pushed all the way up to 33.12. So not quite 50 pips, but again, when we break that high and we see that consolidation, either taking the money off the round numbers, whatever that may be. And again, working from the extremes, you'll notice on this first leg down, they pulled it back. We now have a low of the day in place. They came back a second time without any follow through, and we have a middle structure. So we can possibly look at this as a measured move area. Again, we got one full expansion and then the market consolidated. Once we pull back inside and it didn't follow through, I would cover that trade, because that's probably, especially at the end of the 12 candle window, we're probably done for the session. 3 pushes, 3 sessions, 3 pushes over 3 hours, 3 pushes down over 3 hours, and again, creeping trend up, creeping trend down, fast explosive move to the high of the day. Trading the fast moves. We'll look at the pound Aussie. Great example again on the pound Aussie. Yesterday we saw Asia put a high and low in place just as the day began. We have not quite a 50 pip box, but pretty close. But more importantly, we see 1 push, 2 pushes, 3 pushes down, pin to the low. So we talked about this. Pin to the low of the day, but price stayed above that. So again, we're in the gap time. It didn't pin through the low, it pinned through the low of Asia after a pullback. So instead of just pulling down, we'll look at that trade as well. We now have our W in place. The market broke above that, and then 1 push, 2 push, 3 pushes for an explosive move straight through the high of the day. So again, these 3 push patterns, pay attention to them. The market broke through, stop hunt to the high, but then pulled back on top. 1 push, 2 push, 3 pushes into our 12 candle window, engulfment for an explosive 75 pip move through the high. So we talked about the example of the pin bar. Everybody's charts may be slightly different in terms of their first bar of the day, but I was talking about the market had gone up and put a peak formation in place before dropping down and consolidating and then breaking through that swing low in Asia. So we have 2 things. We have the high bull and we have an engulfment of the initial opening range in Asia before they drop down and go into consolidation, pull back, and then roll over. So this is an existing short trade. The market is in a downward short move as we head into the 12 candle window. The market is dropping down and we see this bullpen hammer. Now, we're not quite at the low of the day, but we're in a downward move. This is different than a stop hunt with a 1, 2, 3. So important to understand, that could be the low of the day, but they may not be done going to there yet. So they put the low in place, they pull back, but then they hit it again, pull back, and then hit it a third time before the 12 candle window. So the pin needs to be through the level to be a stop hunt. Or as we see here, they pin down on the second push, pull it back, come down for the third push. They've already hit the stops, but this pin is inside of the low of the day in a downward move. We don't have a low of the day in place yet in terms of this downward leg. They break out, they pull back, they hit it, they form a peak formation low, they come back and they hit it a third time before exploding back up to hit the stops. And again, the difference, comparing that to the pound from, I believe it was Tuesday. Yeah, Tuesday. We had a high of the day. We had a breakout. Early in the session, 25 pips. They went into consolidation. We had stops in Asia. Again, we pull back, and then they go 1, 2, 3. But we have an engulfment right off the bat, 2 candle reversal after the stop hunt that comes right back inside of the range. That's different than a market creeping down in a short trade, giving us a pin bar. Now, important to understand, the market could be forming a low, but that is not the low just yet. So hopefully you got some value out of today's video, traders. Creeping trends will explode for fast moves. Typically, they will be stop hunts to the high or to the low of the day, and we'll often see them in that 12 candle window. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.